And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. It's a really tough market out there, folks. Rolling banking stress. We've got debt ceiling negotiations, inflation worries. We have recession worries. Some clients are moving into cash. Others are moving into treasuries. Others are buying protection strategies to benefit when the markets move down or sideways. So let's talk about what's next for the markets and for the ETF space. Joining us now, Anna Paglia. She's the head of ETFs and index strategies for Invesco, and Scott Ladner is the CIO of Horizon Investments. Welcome to both of you. Anna, you oversee the triple Qs, which tracks the NASDAQ 100. This is the big star ETF performer this year. It's up 21%. But I get all sorts of cynical comments when I point this out. They say the tech rally is mostly mega cap like Apple and Microsoft and Nvidia. 60% of the NASDAQ 100 is down this quarter. So tell me, what are people doing here? What kind of flows are you seeing? Are they buying, selling? Are they shorting the triple Qs? What's going on?
Bob, you're absolutely right. There is a mixed story when it comes to the QQQ. The fund is up almost 22% and is outperforming the S&P 500 by 14%. And with such strong performance, you would see phenomenal flows into the product. But in reality, year to date, the flows in QQQ have been flattish. But by converse, flows into the mini Q, the QQQM, which is for buy and hold investors, have been positive. And to us, that indicates that the growth story resonates with clients, but there is a wait-and-see approach because people don't know if this drive, if this performance is only driven by the mega caps or if there is more in there. We are still firm believers in the QQQ, but it's a wait-and-see for our clients.
Yeah, it's a tough play this year with that triple Qs. I want to just move on. We'll come back to that. But the other big game this year is fixed income. That's dominated the whole industry flows year to date, essentially. And treasuries, as we all know, they're the big winner. You've had great inflows into your treasury collateral ETF, that's LTLT, that invests in the short-term treasuries. All of those funds have been doing great. But there's also some interest I see in active fixed income in more targeted areas. Preferred shares are getting some attention. Bank loans, you run that BKLN as well. Tell us about why people are starting to target more specific areas of fixed income other than treasuries.
Bob, if you look at the fixed income market, ETFs have crossed $1 trillion. So it took a shorter period of time for the fixed income ETFs to cross $1 trillion than it did for the equity segment of the market. And we expect this segment to cross $5 trillion in the next 5 years. However, not all fixed income ETFs are created equal. What we are observing is that our clients want to have more power and more precision in the way they allocate to fixed income ETFs. So you don't see more focus in bulk beta strategies, but rather you see a lot of flows, a lot of focus, a lot of attention in these more laser-focused, precise strategies. It is a smart beta or even an active fixed income ETF story, but definitely fixed income has been dominating the markets year to date.
Yeah, Scott, let me bring you in here. You oversee $8 billion in assets. More than half of that is exchange-traded funds. So you allocate amongst your portfolio using ETFs very liberally. Investors seem interested in treasuries this year, but not that interested in equities. And I'm curious about that. What are you seeing, and what are you advising your clients now about equities?
Yeah, Bob, you're right about that. I mean, we have seen a lot of interest, a lot of renewed interest in the fixed income world in general, and really like the cash world specifically. So kind of the short-term space where you can get paid 4% and 5%. With that's understandable to some degree. I mean, look, we haven't had any gains in global equity markets for almost 2.5 years, and so people are kind of tired of waiting. And so the interest in a kind of short-term high-yielding sorts of instruments, we think has made some sense over the last 6 to 12 months. But we think over the next 6 to 12 months is probably the wrong place to be. Because if we are in sort of a disinflationary period, and we've seen the peak of inflation and we've seen the peak of rates, we think the equity allocations, even though they're shunned and they're hated right now, they're probably going to be a better place to be for investors, as we come into the summer and the fall time.
You know, it's amazing, Scott, in equities, how negative the sentiment is. And of course, this is bullish because people are on the sideline, but nobody seems to want equities these days. It seems to me that there is an opportunity here. I want you to expand on your point that you just made. Negative sentiment, number one. Number two, the possibility that inflation is coming down, the Fed is done cutting rates. And number three, earnings keep holding up pretty well. This earnings, recession that we've been waiting for 6 months, so far hasn't happened.
Yeah, and look, you're right. I mean, we've been waiting for this recession, the most forecasted obvious recession in the history of the world for over a year. And it's always 6 months away. And we think in 6 months, it's going to be another 6 months away. This is an economy where we have an underlevered U.S. consumer. We have an underlevered U.S. corporate stance. People are spending money, companies are making money, and rates have peaked. That's not a bad backdrop overall. And just like you said also, Bob, the fact that sentiment is very poor and very bearish, it just adds some fuel to the fire. So, it's going to be rocky. I mean, look, we still have debt ceiling worries, and we still have things to worry about. But overall, we think that the positive catalysts and positive stories for this market, why this thing can go higher over the next 6 to 12 months, are really underappreciated right now.
Yeah, it does seem to me that the risk is to the upside, particularly if we get some resolution to the debt ceiling. But Anna, let's get back to equities. I want to get back to this big cap tech divergence because it's got everybody all up in arms here. The triple Q is the star. But again, 60% of it is down this quarter of the triple Q of the NASDAQ 100. Traders seem uncertain as to whether the dominance of a small group, and here, look, this is why we're up so much this year, particularly triple Qs, Apple, Microsoft, Alphabet, Amazon. When you get this group moving this much, you're going to be up, even if the rest is not. Where do we go from here? I know you're not a tech strategist, but the big question is, does this divergence continue?
Well, I don't know if the divergence is going to continue, and I don't know that our investors know that themselves. But this is why I think we continue to see divergence between the flows into the QQQ and the flows into the mini Q, which is the QQQM. So QQQ is really used by traders and by big investors, really using short-term sentiment to make investments in the Qs. And if you look at that, if you look at the flows that are flattish year to date, that indicates there is really not a high conviction in the short term. People are waiting to see how this conversation with the mega caps and tech is going to play out. But if you look at the QQQM, which is the mini Q for buy and hold investors, that's a different story. We have seen positive into the fund, which indicates there is a longer-term conviction on growth. And this is the longer-term conviction that is going to drive flows in the funds outside of performance. I mean, performance has been striking, 22% compared to 8% of the S&P 500. So it really depends on whether you have a longer-term view or a short-term view. Short-term, a little doubts. Long term, there is a positive and high conviction on the strategy.
For the last 7 or 8 months, and Scott, I want to get your thoughts on this too, but we keep hearing this word quality. You, Anna, oversee the Indexco Quality ETF, which is SPHQ. Why is quality attracting a lot of flows, and how are you defining it? It's the word quality is a little slippery to me, and the way I used to define it years ago, it means rising earnings and a strong balance sheet. But how are you defining it? Here's, by the way, the main holders, Microsoft, Apple, and Meta in the quality ETF that you oversee there. Tell us a little bit about it, and what's the criteria?
Well, the stronger balance sheet is definitely the main driver and the main criteria to describe the quality of a certain stock in a portfolio. We see flows in SPHQ mainly because the equity portion of a client portfolio year to date has been driven by uncertainty. So our clients are really worried about what they see in the marketplace, high interest rate, high inflation. They are trying to weather uncertainty by using specific ETFs, equity ETFs. So it's not a coincidence that you see high quality and low volatility being in the driver's seat this is not really an investment story for returns. This is more of a defensive story that plays well under the current market environment.
Scott, this word quality, what does it mean to you? And do you have some way of telling your clients about it? And is there a time when low quality is a good thing? What's the opposite of quality? It's not necessarily value. What would be the opposite? I'm trying to educate traders and investors about this word and what to like about it and what to be cautious about.
Yeah, look, when you think about quality, Bob, I mean, the way people generally define quality is, quality balance sheets, good cash flows, low leverage, and generally like somewhat immune from the economic cycle, not completely immune from the economic cycle, but certainly more disconnected than than some of the junkier names. And so, to answer your question about the other side of that, the other side is more of a junk portfolio. But when you think of junk portfolio, it sounds bad, but it's not necessarily bad at the right time of the cycle. When you want a junk portfolio is when you're kind of coming through the trough and you're starting to rebound out of a growth trough, because then that's the time when you do want high leverage. You do want variability, kind of exposure to the economic cycle, and you want basically a lot of leverage in the system. And so think small caps, think small cap growth. Those types of names are more on the junky side when we talk about junk versus quality. But Anna's right. Quality is probably the safer place to be right now. Because we do have slowing economic growth. Like, we don't think we're going to get a recession, but we're definitely going slow growth, and we're certainly going to have some margin compression. And so in an environment like that, it does stand to reason that you should have some exposure to some of these more high quality names, higher quality balance sheets, lower leverage, lower interest expense, these types of things. And at the end of the day, one of the most important aspects to that is it could provide some form of safety and could keep people invested or get them invested in the first place, even if they're a little bit scared. So that behavioral modification aspect to investing in a quality portfolio at a time of economic uncertainty could be just as powerful as the economic implications of doing that.
And the other play this year, so we had tech and we had this quality play. We also have a defensive play, low volatility. You run the low volatility ETF as well, oversee it. SPLV, I wonder if we could put that up. Sam, Paul, Larry Vulture is the symbol there, SPLV. It tracks the 100 least volatile stocks in the S&P 500. What's pushing investors into defensive sectors? And I would notice these are the classic names you would think. You have Pepsi, Mondelez, McDonald's, Johnson & Johnson, Merck, all of these. Healthcare, utilities, and consumer staples are in these, essentially. Anna?
Bob, we see that the SPLV really resonates with our clients in period of times like the current market environment or even last year, 2022. Volatility is something that drives flows in and out of certain asset classes, but in an environment in which people have to weather uncertainty a little bit. They try to allocate their assets into some stocks or some ETFs that give them access to stocks that have a low volatility. This fund, as you said, selects those companies that have exhibited a lower level of volatility historically. And that gives people some stability. Stability is important in a time of uncertainty, and it's the same thing that we have talked about quality. Right now, people are using flows, and we are seeing flows into equity that are really defensive in nature. So whether it is quality, whether it is low volatility, people are really trying to make sure that their portfolio is not exposed so much to uncertainty. And this is why this story is so strong with our clients.
Scott, I want to just move on to another asset class, and that's commodities. This has been a tough call this year. The China reopening play has kind of fizzled a little bit. Oil's been sort of stuck at $70. We had a little run up there in January, February on hopes of a big China reopening, and it's happened, but I don't think it's happened in the big way people were anticipating. So I know Anna runs several big commodity ETFs. There's a base metal ETF, DBB, that she runs, and there's the oil fund, DBO. But I'm wondering, if, Scott, if you can just comment on what role does commodities play in any portfolio at this point? It is an asset class. Does it have any place in 2023?
We think actually the commodity story, It might be a tough one. This going forward might be a little bit of a tough one. Bob, like one of the things that you highlighted in terms of the catalyst, one of the positive catalysts that people were counting on to push commodities forward this year was the China reopening. And to be clear, we are getting a China reopening, but it's not exactly the China reopening that people had thought about. The China reopening we're getting is a Chinese consumer reopening. It's not really a Chinese state or state-owned enterprise reopening. And so we're not seeing all this kind of top-down stimulus out of the Chinese government. We are seeing people in China spend money, especially on luxury goods. And so, to differentiate between, a Chinese consumer reopening, which we are experiencing right now with things like first or second inning of that, versus a kind of a state fiscal stimulus sort of top-down reopening, that we're just frankly not getting. And it's that top-down kind of state-sponsored reopening that we really thought was going to, people really thought was going to propel commodities. And that's kind of what you need for that story to really work. But in the context of a global growth slowdown, like not disaster slowdown, but a slowdown with a kind of a sluggish Chinese official response to the reopening, we think the commodity story might be a tough play for the rest of this year. Not forever, but for the remainder of this year, we'd just rather be in equities, and we'd rather be in Asian equities if we're going to play that kind of story.
And talk about flows. The two big ones, as I mentioned, DBB. This is a base metal one, so we go in aluminum, copper here. Three base metals. These are futures, and then we have your oil fund, DBO. What kind of flows are we seeing here? And one of the tough things to do, talking about investing in these, is explaining the role here and the fact that when these are in contango, you have to, the roll gets expensive, and it's a problem for investors. I constantly get pointed out about warning investors on the costs of that particular role, and I wonder if you can address that as well.
Sure thing, Bob. So the word sluggish in terms of flows is the right word, because flows have been flat to negative this year, which is if you compare 2022 and 2023, is a little bit the tale of two cities. 2022, incredibly strong market for commodity ETFs. 2023, it's a little bit of a mixed story. Now, when it comes to the role, we employ a strategy called optimum yield, which is a strategy designed to really select the months in which the strategy believes the investment and the rolling of the futures is going to make for the optimum yield. What it means is that we don't roll from one month to the next necessarily if the next month is not going to be designated as the optimum month for a roll. So if you follow the strategy, it doesn't matter. You don't have to track whether the market is going to be in contango or in backwardation, because the strategy is going to look at historical cycles and do that analysis for you. And if you look at these funds, they have outperformed the base commodity markets, especially due to the strategy. So when it comes...
Go ahead, sorry.
So I think that selection matters when it comes to commodity ETFs, but I agree that the rest of the year is not going to be just like 2022.
So just on the roll, because I get questions about this all the time, you're saying on DBO, normally you would roll over into the front month contract, but in some circumstances where it might not be advantageous, you might not roll into the front month. You might roll into a contract 2 months out or 3 months out, for example.
That's correct.
All right. And Scott, let me just give you the last word here. The problem we're having is the investors are much more confused than usual. The commodity play, as you mentioned, is a really tough call. There's got some positives. The dollar's a little weaker, but the China play is fizzling out. Treasuries, everyone is lopsided into fixed income. Everyone is lopsided into treasuries. There seems to be some opportunities elsewhere, but there's not huge flows there. And everyone seems somewhat negative on equities. So this is a really tough call. The investors seem very confused. Half of them want to believe an imminent recession is here. The other half, as you said, don't see it and don't believe it. So is it the best strategy at this point? Stay the course, know where you are in your life, know how much risk you want to take, keep investing the same amount of money, and don't worry so much. I go back. I'm starting to sound like Jack Bogle here at Vanguard, but isn't that the logical thing to do in something like this?
Yeah, it is, Bob, but that can be hard to do. And because if you're nervous and you're reading headlines all the time and you think that, the world's coming to an end one way or the other, prices are going up, there's a war in Russia, Ukraine, the Chinese consumers not coming back, there's plenty of things to worry about. And we hear about them all the time. And so if you're the end client, if you're a retail client and you don't live and breathe this stuff every single day, it can be hard to put into practice that which is economically and sort of rationally optimum, which is just what you said. Keep investing, stay on plan, stay on track, don't panic. And so a middle ground for people like that, or middle ground to kind of dip a toe back in and get into a market that we do think is going to end up being pretty good for the next 12 months, even if the next 12 weeks might be a little bit rocky, is to engage in some sort of protection strategies. So Anna, you and Anna talked a little bit about low volatility strategies, low volatility investing. That's a way to get in. There are other protection strategies out there. At Horizon, we obviously run a few, but there's all sorts of different ways you can skin the kind of hedged equity or protected equity cat. And those strategies in general can get an investor involved and get it back in the market with some degree of expectational certainty that they're not going to get killed if things really go off the rails. And so we think that's probably a good way back in for a lot of folks.
We want to talk about those protection strategies on the podcast with you, Scott, but I'm going to close by reiterating a comment that Jack Bogle, founder of Vanguard, made many, many years ago. It's sometimes doing nothing is the best strategy. He used to say, don't just do something, stand there. And I know that's contrary to what most people's impulses are, but often trading around market events usually is a mistake. And ultimately, you want to have one strategy and stick with that strategy, which usually does not involve market timing. That does it for this week's ETF Edge and my little lesson for the week. My thanks to Anna and Scott. We've asked Scott to stick around and give us his perspective on broader investing trends for the ETF Edge podcast coming up. Remember, you can see all of the shows on our website. That's etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.